This is the #1 strategy for tax savings on an IRA. We are going to address the question in this episode: how do I transfer money out of my IRAs or 401ks or other qualified plans into a tax-free vehicle? I'm Doug Andrew. You're going to be blown away when you see how to do this, and this is an actual client that we helped optimize their assets and minimize a ton of tax by doing this strategic rollout. So I'm Doug Andrew, and I've been a financial strategist, retirement planning specialist, tax minimization specialist for 47 years. I helped a lot of my own clients with these strategies, and then in 2003 to 2007, I trained over 3,000 CPAs, tax attorneys, financial advisors on these strategies, but I got frustrated because they weren't going out and helping their clients. They said, Doug, we don't have time to educate people like you do. So what the public doesn't know won't hurt them. Well, yes, I see a ton of people paying unnecessary tax on their IRAs or 401ks at retirement. And so that's when I let all my professional licenses automatically expire the last business day of 2005. To become a consumer advocate, to write books and to do educational videos. And my most recent book, The Laser Fund, has actually 14 chapters of charts and graphs, but this side has about 100 pages with 12 chapters, and it talks about stories and examples. And this is one of them in this book, that we actually helped this 70-year-old man get money out of his IRAs and 401ks with no tax consequence. I'm going to simplify this, and I want you to understand that this man is very typical to many, many people that come to us and they thought they were going to be in a lower tax bracket when they retired. This gentleman did very well for himself. He owned a lot of rental properties. These were duplexes, triplexes, fourplexes, and so forth, the smaller apartment complexes. He'd done very well for himself, so he didn't need income out of his IRAs to live on in retirement. And so he sort of took the advice that most CPAs give. Oh, if you don't need the money, defer. Just put it off and postpone until you're age 70 and a half. Now you have to start pulling it out at age 72 to avoid a 50% penalty. When he came to us, the age was 70 and a half. So he came and he said, you know what? I have to start pulling money out of my IRAs and 401ks now, or I'm going to be penalized 50%. The CPA says I should just take out the required minimum. What do you think? And I went, that's the worst advice I've ever heard. So let me show you what his advisor told him to do. Now, this was in the year 2010, 2011. And this man had his IRAs and 401ks from 2000 to 2010 in the market. He had saved $600,000. But that $600,000 in the year 2000 went down to less than $360,000 by 2003 because of the market. It dived for 3 years in a row. And it took 4 years to get back to $600,000 in 2007. Then in 2008, he lost 40% again and went down to 300 some odd thousand. It took until he came to us in 2010, 2011 for it to be back to 600,000. We call that the lost decade. So when he came to us, he finally had his 600,000 back that he had 10 years earlier. Isn't that sad? Now, his advisor said, hang in there, hang in there. The market will always come back, but take out just the minimum distribution. The financial services industry has a standard. It's called the 4% rule. If your money's in the market, Dalbar, who studies investor behavior, says that the average investor in the market, especially in retirement, only earns about 3.49% because they're buying and selling at the wrong times. I mean, if they bought and held, they would earn about 9.14%. But 9% without paying tax is really only netting them 6% because you got to pay tax of about a third. Well, he knew that, but the advisor didn't want to be sued for him outliving his money. So the advisor said, you know what? Just take out the 4%. Well, this is pretty pathetic. What's 4% on 600,000? a measly $24,000. He pulls out $24,000 and he has to pay tax of a third. He's in a 33% bracket between federal and state tax. That was $8,000 of the 24. So here he is pulling out $24,000. He's netting only $16,000 to buy gas and groceries, prescriptions and golf green fees. That's pretty pathetic. He, if he dies, would only really leave behind $600,000 to his heirs because his wife, when he came to us, had just passed away. So if he dies, his children will have that $600,000 and they have to get that out and taxed within 10 years now, or else they're penalized 50%. So it's really only worth $400,000 to his kids. Have you got the scenario? This is what most advisors and CPAs tell you to do. Let me show you how we dramatically increased his retirement income and saved him a grundle in unnecessary tax. So stay with me and you'll see this is so powerful. We have done this for thousands of people. What we did is we had this man take withdrawals out of his $600,000, far more than he needed to live on. He didn't even really need this money, but he was forced to take it out. But that's a pretty pathetic rate of return. So we told him to take out $12,500 a month in a payout. We had his money diversified into a portfolio, and the $600,000 was in an instrument that would allow him to realize about an 8.25% effective rate of return on his money. He was able to pull out $12,500 a month or $150,000 a year out of his $600,000. Now, if you do the math, $150,000 times 5 years is $750. Well, yeah, because he's earning interest on his money while he's rolling it out. Your money just doesn't stop growing, but we increased his rate of return quite a bit, more than double than the 4% payout with his money in the market. The point is this: worst case scenario, if he pulled out $150,000 each year, it's like, well, I don't need the money. Why am I pulling out more than the RMD? To get the taxes over and done with sooner than later and reposition it into something tax-free from now on. Let's say that he pulled out $150 and in a 33% bracket, he paid a third in tax. That's $50,000. So after 5 years, he withdrew $750,000. It's all out of there. And he paid a third of that. That's $250,000 in tax. People say, well, that was bad advice. No, you're not safe. He's going to pay it sooner or later. Later, it's going to be more than that. So let's do the math. He pulls out $750,000 over 5 years. He pays $250,000 in tax. What does he have left? $500,000. Now that $500,000, he has that in his laser fund. That's my favorite vehicle to reposition the money, after-tax money. $500,000 in his laser fund was earning between 8% to 10%. Because we were rebalancing, he actually was earning 10. Let's just take 8. So 8% on $500,000 is $40,000 a year tax-free. That's just the interest. How much more is $40,000 than $16,000? A lot more. Okay, but he was actually earning 10%. So 10% on $500,000 in the laser fund is $50,000. $50,000 tax-free is how much more than 16? About triple, okay? Now, that's not where we ended. See, I'm a tax strategist. What we did is the third part of a strategic rollout. We resurrected some deductions he had been killing. How did we do that? So we already had enabled him to be able to have triple the amount of money, cash flow tax-free, by doing the strategic rollout, increasing his rate of return, actually increasing the safety, and of course the tax advantages. But you know what? I just can't stand to just do that. I want to dramatically increase his net spendable income by saving unnecessary tax. So in his case, he had several of these rental properties, duplexes, triplexes, and so forth. And he had been paying them off, thinking that was his retirement. That was pretty good. I said, wait a minute. Do you understand the velocity of money? If you borrow money out of those rental properties at 4.5%, which is the interest rate at the time, it's tax deductible. On Schedule E or on your LLCs, you can tax deduct the interest. So every million he borrows on those apartments at 4.5%, that's $45,000 of interest he gets to deduct. In a 33% bracket, it's only costing him $30,000 on every million. So he's making in his laser fund 8 to 10%. Let's just take the average, 9. How much more is 9 than 3? He's making 300% on every dollar. On every million he borrows, he pays $30,000 a year and he makes $90,000. He says, Doug, you're making me so much money. I don't know what to do with all this money. I said, well, you can give it to me. You can give it to charity. You can do so much more with it. He used this to bless the lives of his kids and grandkids in his family bank, which is another concept. But what was the strategic byproduct that came along for the ride? Those new deductions that were no longer on his tax return when he paid off those rental properties came back onto his tax returns. That gave him the ability to earn 3 times the cost of the funds for the mortgage, but it offset. Every year he pulled out $150. The deductions on his rental properties now were equal to that. It saved him the $50,000 of tax every year for 5 years. 5 times $50,000, we saved him $250,000 there. But as we rolled it out, we actually did it over a 5-year period. And so guess what? He didn't have a net of $500,000 in his laser fund. He had a net at the end of 5 years of $750,000. He got all this out with growth, tax-free. $750,000 now at 8% gives him $60,000 a year, not 40. At 10%, he can take out $75,000 a year tax-free. How much more or better is 75 than 16? People sit here and they get this deer in the headlight look. Like, what? You really did that? And when he dies, what did he leave behind to his heirs here? A net of $400,000. Here, if he dies, this inside the laser fund, which I explain in this book, blossoms to $1,200,000. Triple. Okay? Why would you generate this much income in retirement when you could generate 3-4 times that? And why would you leave behind this $400,000 when you die, when you could leave behind triple that if it doesn't cost you anything? You can actually have your cake and eat it too. If this is resonating with you, read this story and others in this book. I would love for you to get a free copy. You can click on this episode, watch it. You'll understand this concept, and I'll fire one out to you. You just pay $5.95 shipping and handling. But there's other episodes also I want you to watch that relate, that shows several examples just like this one.